Most people don't think of strategy that way.
Developing a new strategy.
Strategic blind spots.
When strategy meets reality.
Strategy and innovations.
In the strategy world.
Drive their strategic goals.
And welcome back to Strategy Meets Reality podcast. And welcome back to the Strategy Meets Reality podcast. I'm absolutely delighted to be joined by Andreas Panayiotou from Notion. I'm really excited about this because I've noticed that a lot of the time we talk about, or I probably talk about large organizations, where actually we're going to be talking about organizations from the different various scales. So I'm so happy to have Andreas with us. So welcome, Andreas. Thank you for coming on the show.
Yeah, thanks for inviting me. And you nailed my surname, so well done. I feel like you've been practicing how to pronounce it. Just to clarify, so I work for a venture capital fund called Notion Capital, so not to be confused with the app Notion. So we had to rebrand recently just to make that really clear. So yeah, I'm an operating partner, so not an investor myself. I work with our portfolio companies.
Nice. And I'm looking forward to exploring what we mean by that. But just for a bit of background about yourself and anything, give context what you've been up to, share with our listeners.
Cool. Maybe I'll also kind of share a bit about what venture capital is. I didn't really fully understand until I joined. I started my career in consulting for 8 years. Didn't want to be a consultant forever, but gained some quite kind of useful skills, general consulting skills, but then also a lot around go-to-market and pricing, monetization, and then joined a former client. So went to a large business that had been spun out of Thomson Reuters. So got to experience the difference there from kind of small consultancy to a large kind of bureaucratic entity. And then joined Notion Capital about 4 years ago to be kind of on what we call our platform team. So that's sort of after you've invested in a business, supporting the business basically. And so, yeah, I didn't know a lot about venture capital when I joined. It's a really small industry globally. I think it's a bit of a cottage industry. So there's probably only a few thousand sort of venture capital firms globally. I'd say it's a pretty immature industry. I was very surprised at how immature sort of internal processes and just the way things were run in industries. So they tend to be they're very small companies. So for example, Notion Capital is just 30 people managing, I think, just over $1 billion in assets under management. And essentially how the kind of industry works is we raise money from what we call limited partners who are looking to get exposure to early stage, high growth startups, essentially. And then we take that money and we deploy it into early stage businesses. And it works kind of on a fund basis. So you'll raise a bunch of money in a fund, a couple of $100 million, and then you'll deploy that over a few years. And then you'll hold those assets for around kind of 10 to 12 years in total. So it's, you're playing the long game. You're taking on a ton of risk. So you're going very early. You're really betting on the possibility of kind of a highly improbable outcome. So if you invest in, say, 20 businesses, between 1 and 3 are really going to generate the returns and the rest don't really move the needle. So for each fund, you've got this kind of power law. That's sort of how it works. So what you're trying to do is kind of knock it out of the park rather than go for singles. You want those 1 or 2 businesses that just get massive. And then if you look across venture capital firms, you see the same pattern. So you've got the top firms that do really, really well, and then the sort of long tail of actually quite poor performance.
Okay. That's interesting because when you think about, or we've challenged on here before about leaders in strategic roles, they're normally very short-term focused. So actually to have that sort of ability to place your bets and think long-term, definitely over 12 years, that's pretty much unheard of or very uncomfortable for a lot of leaders to think about.
Yeah. And now I've worked quite closely with founders now over the last 4 years. That's the key person I sort of interface with and their direct team. And it's a really tough journey they're on. So they're on this journey from, starting a business with basically, zero revenue and hopefully getting it to 100 million plus. And when you take venture capital funding, that's what you're sort of signing up for. You're signing up for this very aggressive journey. And because if you don't go for that massive outcome, the whole model kind of falls apart.
Yeah.
So everyone's sort of pushing and wants you to move fast and wants you to go for a massive outcome. And it's really sort of impressive, the sort of pressure that founders have to deal with, the amount they need to also grow as individuals, and the number of challenges they need to sort of overcome. It's, I have a lot of respect now for founders, having seen just how difficult that journey is. And so, part of our role as investors is to help support them as best we can. For example, pointing out some of the common mistakes we see. Every business is unique, but there are kind of patterns and sort of common challenges, and just trying to help them get ahead of some of the more common mistakes, so that hopefully they make their own mistakes, not the mistake that kind of every early stage business makes.
Yeah, I think that's wise, isn't it? What's the point in treading over old road that you know is not going to work when you can actually focus, especially at that founder stage where you haven't got much capital, you haven't got much resources, you can't really afford to take that time going over old road, when you might as well take the wisdom. You can see what can go wrong and you avoid it.
Yeah. I guess just on your kind of journey point where it's, it's a 10, 12-year journey, is I think what we find as well, and you kind of see that with the big outcomes as well, the really big successful businesses out there, they're still founder run, right? So like, how long was like Bill Gates there at Microsoft, or Jeff Bezos at Amazon, or now with Elon Musk at SpaceX, or I know the Google guys weren't the kind of, didn't have the CEO position, but they were there sort of with the CEO running the business. So there's something special about a founder still leading that business, even at scale. Yeah, I think that's interesting.
Yeah. Is that because they don't want to let go, or they're still
I think they're not that they don't want to let go, because I think every founder is different. Some actually very early on realize maybe their personality and what they want isn't actually to be the CEO, and they want to be the visionary and kind of the inventor sitting alongside others. Want to have that role and are good at it. I think, a lot of the times actually they're just best placed to run the business, even if they haven't done it before. Like, it's all first time for everyone. They might not have run $100 million business, but they might get there and find themselves running it. But they tend to learn a lot, so they develop. They go through this like extraordinary development journey. So the business is developing, but so are they as individuals. And I guess because they've been on that whole journey, they understand the business intimately, and they've acquired the kind of soft skills and other, I guess, capabilities they need to be successful at scale. But they've also, by that point, surrounded themselves by an amazing team. This is something we can kind of talk about, is obviously they don't do it alone, right? So they have great people along that journey. And they might be, and often are, completely different people, right? So the people that get you from like 1 to 3 million in revenue are not the same people that are with you at 100 million.
Yeah, we've mentioned that before. Well, we've had a conversation about this before when we last spoke, and that must be quite a difficult challenge. And I really want to get into that sort of journey. So, what's that journey from 1 to 1 million, 100 million? How does a business need to change over that journey from your perspective? But just a quick one before we get on that is that must be a really difficult challenge, that you've got someone that's a really good person that has got you to, say, 3 million, but they're just not the right person to lead you to the next thing. And, it's not like you'll just cast them out the business. It just means they have a role. The role grows probably bigger than them, so they'll stay at a role, and you'll get someone that can take the next sort of curve level.
Yeah, because there's a real like human element to this, right? That I think you don't hear it as much, but if you're in the venture capital ecosystem, you'll hear a couple of things. You'll hear kind of higher game changers or higher A players. I don't really like those terms so much because you're kind of stack ranking human beings, right? Like you're an A person and you're a B person. And I don't think that's not actually how things work. It's you're a certain maturity of business and you've got certain challenges and certain jobs to be done. And there are people out there with the skills and capability to overcome those specific challenges at that point in time. And they could be really good at it, right? So it's much more about fit with the task.
Yeah.
So early on, it's really about kind of generalists and builders. So you want the people that can wear many hats and can build the processes that you need to be successful, to kind of be repeatable. But that's quite different to maybe what you need when you're much more mature, when you maybe need more just someone that's more of an operator that can kind of operate the machinery. So it's much more about fit. And so, you'll surround yourself by people that are good at that stage and will help you progress over a year or 18 months. But then if the business is growing, it's a completely different business. I think it's better to think of it as really different businesses. So a 1 million euro business, even though it's the same business, is completely different to that business at 10, 30, 100 million. It's just different. And so, is that person right for that stage of growth, both for the business, but also for them? Because it's probably not what they enjoy doing, because the nature of their role will change significantly. So they'll go from maybe being a bit of a generalist to being highly specialized. And it's, do they want that? Or actually, would they much prefer to go do that journey again? So, you join a business at 1 million, take them to 10, and then you go do it again. And it's like, that's what you're really good at. Keep doing that, because you won't necessarily enjoy the job, whatever job you have, whatever it becomes, you're not necessarily going to enjoy it either. So I think it works both ways.
Yeah, and you're right about that enjoyment part, because like you said earlier, there's a lot of pressure, going from the stages we're going to talk about, but going from that 1 million to 100 million, there's a lot of pressure there. And you've got to sort of enjoy that pressure on that stage that it's in. And some people have a natural preference towards certain things. I'm agreeing with you there. I don't think it is, people that are better. It's just in that environment, there are people that are more suitable, have greater fit with that. And then if they got fit, then, that's going to do everyone and themselves a lot better. So think about that then. So the journeys from 1 to 100 million, what does that look like? And what are those various key stages?
Yeah, so there's these kind of chasms along the way. So it's not this nice, smooth, linear journey. It's these sort of sigmoid curves, right? So you get, you're kind of building capability, then performance is improving, and then it sort of goes horizontal a bit maybe. And so you're trying to get ahead of that, and you're trying to stack these curves on top of each other. And we think of these sort of revenue thresholds just as sort of a heuristic where businesses tend to get stuck, and they tend to get stuck at around, the first kind of threshold is maybe at about 3 million in revenue.
Okay.
And so they've built a product which is valuable. They've managed to sell it to, some customers, but then things kind of stall because they might have product market fit, but they essentially haven't worked out how to sell. So they haven't clarified where exactly in the market they should focus, and who they're building for, and how they should position themselves in the market, and how they should talk about their proposition, and what the sales motion should be, and built like the sales processes you need to be repeatable. And then things kind of stall, and probably during this period, they're also burning quite a lot of money. So they raised, I don't know, 10, 20 million pounds. They deployed that capital hoping the growth would would appear, and maybe they made a few mistakes in their strategy or just some bad luck. And so they've burnt through that capital. The growth didn't appear.
Yeah.
And so they get a bit stuck. And so that transition from having a product that's like quite strong to actually selling it in a repeatable way is this first sort of chasm. And so about 40% of businesses that raise from venture capital get stuck there, which is like it's actually quite a high proportion.
Yeah, yeah.
Are getting stuck pretty early in the journey.
You can see that really, because if you've created products and you believe in that product, of course you believe it. You've just invested a lot of money in it. It's probably hard at a point then to think why is no one buying this product? I've got people buying it, but why is it not growing? I see this still in large organizations for leaders that challenge. They get into this point, but we've built it, and it's almost a bit like Field of Dreams. Remember that film? You know, if we build it, they will come.
Yeah, which is not the case.
No, that's the case. But I think that's the sort of mental trap that people can get into.
So there's this saying, I don't know where it came from, but first time founders think product, second time founders think distribution. Because just because you've built like an amazing product doesn't mean it's going to fly off the shelves. Like no one knows you exist. They might not even realize they have a problem that your product kind of solves, because you're probably doing something very innovative and new, right? By the nature of it being sort of a startup, there's a degree of invention there. So you've built something that hasn't existed before, so the market like doesn't know about it. And one of the specific challenges with a startup kind of founder-led business at this stage is transitioning from, it's always the founder that secures the first deals. So the founder's wearing many hats, one of which is being like head of sales and, using their network to win their first deals, or just sort of reaching out to people and getting those first 10, 20 logos. And actually, even though they don't necessarily come from a sales background or are particularly commercial, they might be very technical, they still close deals and they still actually do quite well at kind of selling, probably because of their passion. And obviously they've put their heart and soul into this business. So I think that comes through. And then they want to transition from them kind of selling to a professional sales team. And that's when things start to go awry. And there's this myth that you can just hire a salesperson and they'll be able to sell your baby, and they can't. So one of the things we really help founders with is to basically document why what they do works, to really think of it as like a process and get down on paper, so that when you do bring in that salesperson, they're operating off a process rather than having to figure it out themselves.
Yeah.
So it's like few people I think are builders. So particularly in sales, like, are you bringing in someone that can build that process, or is it just someone that can kind of operate the process? And there isn't really getting away from, it's the founder that has to do that, because they're the ones that understand the product, understand the market, have been talking to customers, have closed a few deals. So it's kind of on them. And so they have to put that work in before they kind of scale up sales.
I do think there's a bit of, and you see it in the Y Combinator world, and you see it from the sort of the stories, the post-rationalization of stories about these founder-led companies that have really made it. And I think they do, to your point earlier, make it very seem like a quite a linear, cool like thing.
Right.
They bring quite a bit of romanticizing about the founder's journey. But also I've always seen, there always seems to be this maverick that turns up at the right time that can sell and gets in that sell thing. And I think that's something that you see where really what you're saying in it is not like that at all. Actually, we need to try and think about how, what is it? What does this thing actually really do, and how, what's the benefit, and really get it into a proper system, as it were.
Yeah. Yeah,
because
exactly.
Then you're not relying on this maverick. You're relying on good people that will know the product, know the service, and be able to repeat that and to get the
Yeah,
that it needs.
exactly. Then it's kind of repeatable sales.
Mm.
So just to kind of continue that journey, right? So 40% fail to get past 3 million, 60% fail to get past 10. So you've got like this another drop, and then 80% fail to get past 30. So when you're at like 30, you should really be scaling the business. So everything should be fundamentally working. So you've got a product that solves a real problem for a massive market. You've worked out how to position yourself, talk about the product, and sell. So you understand, what the sales motion should be. You've got a process which works. Marketing is generating demand. You can forecast deals accurately. And then it should just be a case of like putting your foot down and deploying more capital into that business, hiring people and just scaling the thing. But that's where you've got this like another chasm. And I don't know, it's not the biggest, I guess at each stage you kind of lose 20% of businesses, but only about 1% get past 100 million in revenue. So it's like 1 in 100 VC-backed businesses, roughly, depending on how you kind of measure it, get past 100 million in revenue, which is really like the minimum you want them to be getting to have any chance of producing a big outcome.
So just a quick one on those, like as you as a VC, what do you do at that point when you know they're not going to get to that past that point?
So what the whole model is built on the fact that that's the reality, right? And so that if you invest in 20 businesses, only 1 to 3 are really going to make it big. And then the next sort of 50% will do okay, like very respectable. And then maybe the bottom kind of 20%, maybe you're getting your money back or it's like a write-off. But that's like the nature of the beast. And as a fund, we want to be, equally supportive to every founder, whether they're growing quickly or not. We're helpful to, all of them equally. That's why they choose to take money from Notion Capital versus another fund. Because venture capital funds, they're providing a commodity, right? Like undifferentiated commodity, which is money.
Yeah.
And it's very competitive. So you're trying to win the best deals. And so the way we do that is by adding genuine value after we invest. And so we help them with that journey. But, as we've discussed, most aren't going to make it to 100 million. But there's other ways to be helpful, right? So it's, for example, you're helping them to still achieve a good exit for, based on what they've built, still getting an exit, which means the founders and employees can still enjoy some upside. So that there's still, we still want to be helpful, even if they're not on that VC sort of trajectory the whole way.
Yeah. There's just always that point, isn't it? There's that ceiling some will get to for various reasons. It's not really about them or the sport. It's just be the environment. The environment has a lot to play on this in the sense of what actually there is fit. You could have a perfect product, but as we spoke about on the show a lot before, is that things can shift in the external environment. Different constraints could pop up, different competitors, different situations, which means that thing is probably as viable as it's going to get at that stage.
Yeah. I mean, we see that a lot, especially with AI now, right? Where if we look at, and we've always invested in actually artificial intelligence for quite a while. It's not such a new thing to us. And if you look at some of the, I have one in mind in particular, an artificial intelligence business we had invested in a couple of funds ago. So maybe we've been invested in for, 7, 8 years. And then, ChatGPT, like OpenAI and Anthropic come out and basically put an end to that business. It's technology is I guess has been leapfrogged, and it's no longer a viable business, and no one saw that coming, obviously, right? So there's a lot of that going on as well, especially when you're still like not a mature business. You're still dependent on outside capital to fund you. And then the outside environment completely changes, or new technology, and then it just destroys it's like creative destruction, right? Just
Yeah.
destroying your business, and there's probably nothing you can do about it.
No.
It's hard.
And it is hard because the rate of change there, you're in that stage from that sort of, 1 to 100 million. We're not talking about a fully resourced with loads of capacity and, extra resources you can just throw at a problem. So you are limited in the amount that you can respond to certain situations. And there's some situations like in ChatGPT and all that lot, the amount of investment that had from the start, you're not going to compete.
Right. Yeah. Yeah. You might not have the capital as well, right? Like this new technology might come out just as you're trying to raise your next round, and then you're just like uninvestable, and it's just bad luck, bad timing. So luck definitely plays a big role in the journey.
Yeah, I think luck is a underestimated thing in strategy, full stop. In fact, as much as we do say about, look to the external environment, but a lot of that really is thinking an opportunity is appeared and you've identified that opportunity and you've been able to seize on it before someone else has. And there is always a bit of luck in there. And I think that gets a lot of underestimated in how much that can play into a lot of people's successes. But yeah, I kind of imagine that, what you're looking for in that, especially when you're thinking about that sort of start build phase, is that they are organizations that are not just going and, head to head with a previous product that's out there and, just sort of just trying to do the same thing and just see if you can battle harder. Probably more on they're creating the conditions for something new.
Could be. I mean, there are some which is just pure head to head, but it's a proposition which is just far superior. So there's something about it which means it will be far more attractive to customers at maybe a more attractive price as well. There's definitely, I think, there's still kind of businesses that I think fit that profile that attract venture capital funding, because you might have propositions that have been in the market for quite a while and they sort of stop innovating and they get a bit stale. And actually in some markets, maybe they never really solve that initial problem they set out to. And there's a number of players like in a particular segment, but they're all kind of shit, to be honest. And and a founder has noticed that there's a market out there. It's an established category. They all suck. Like all their customers hate them, and so there's an opportunity to do something great here. And there's definitely still maybe invention and something unique that goes into that product, but it's going up against kind of known competitors, and just will win based on the strength of the proposition.
Yeah, well, that's what brought Blockbusters down, wasn't it? There wasn't much. Love DVD wasn't much different. The only thing, it was mail order, and you didn't get fined for late fees. That was really the only sort of different proposition.
I guess you see it a lot with like a lot of product led organizations. So with Apple just like destroying Nokia's market share, right?
Yeah,
and BlackBerry's, and them just being too slow. So again, like the environment changing because new competitors enter with new products and you're not able to keep on this sort of treadmill and they fall away.
Yeah. Well, it's the viability principle, isn't it? You must be able to move as quick as or quicker than the external environment or your competitors. Otherwise you'll cease to exist. And you see that from your experience in that, do you find that some founders going through that stage, do you find some will rest on their laurels and they're not really, keep an eye on it? They're just set, they've got this product, that's it. They're not looking at adapting or changing it as the circumstances changes. They're just invested in, this is the product, this is how it stays.
I don't think any founder is like resting on their laurels. They're just by the nature of their personality and what they've decided to go on this like crazy journey, and they have risk on investors sitting on their board that are
Yeah.
also kind of advising and applying pressure.
I think maybe resting in their laurels is probably the wrong word for me. More about, are they still keeping that one eye on the external environment in the future and it changes?
I guess some are and some aren't, and the ones that aren't don't survive because the failure rate is still enormous, right? So
Yeah.
like
Yeah.
a lot of them must be blind to what's going on outside, and so don't react, or do pick up on what's going on outside, but don't have the resources and capital to react, or for whatever reason. So I guess it's different reasons why they don't manage to adapt and change. Maybe one of the most difficult and probably where you need really brave leadership is to actively destroy what made you strong previously to make way for the new. So I think a good example of this, people might be familiar, it was actually just acquired by Salesforce, so a business that was called Intercom, which is sort of customer service bots, I guess. When ChatGPT came out, they were really quick to pivot and use that technology, embrace AI to see how it impacts their product, as well as internal processes, how they develop the product, so their engineering department, but also the brand. So they rebranded to the product name, which was called Fin. And so they moved away from an established brand, which had a lot of respect, called Intercom, to Fin. And I guess the point is they were willing to actively destroy and move away from the things that had made them successful, because they realized the external environment had changed so much that they either decided to do this, you either do this proactively and you become masters of your own destiny, or the market's going to do it to you and some other AI native proposition is going to come out and take market share from you. So I think that's the best kind of recent example of founders moving really quickly and pivoting the entire business because they had to, and they've achieved an amazing outcome. But if they hadn't have done that, it could have been, put them in a really difficult position.
Yeah, I love that. That's a great example, and it really brings to life John Boyd's destruction creation, the ability to destroy your own orientation, to be able to enable something new. And I love that, and the fact that people look at these changes in the external environment, and it does elicit different responses. Like some look at it and they're just like rabbits in headlights and goes paralysis, and then they start defending what they know. And then they just have to react to the situations. And we know if you're reacting, that leads to suboptimal options and positioning. And then those ones that look at it and think, well, okay, so what does this mean to us? Where's it going? And what do we need to do now to adapt or shape the environment to our advantage? And it's more that, that sort of offensive approach that opens up the possibility space. I think that's where true sort of strength goes in. But it does come back to what you're saying about that, or destroying, being willing to destroy that.
Yeah, it's interesting you use the word like offensive. I know you come from like a military background, but it's interesting. I think to run or be part of a high growth early stage business, you've got to be really aggressive. There's actually a lot of aggression in there. Like, you've got to know what your objective is and you've got to go after it with a lot of energy. I guess that's what I mean by aggressive, not like you're
not throwing.
It's like everyone's shouting at each other, but like, just what you want and you're just single-minded in kind of going after it, and you do it with a lot of energy. I think if you don't have that and you're too kind of thoughtful and slow to react, you're probably not going to make it. No. So there's a time for kind of thinking and being thoughtful, and then there's just a time for action. And I think it's quite aggressive.
Yeah, you got to see that, because you look at, a lot of people will sit and pontificate around, what will happen. But we don't know what's going to happen because it's the external environment, right? It's unknown. There's a lot of darkness there. And sometimes you just need that that focused approach to do something.
Yeah.
And see how it responds, and then you can then reorientate quickly to see what's next.
Because you don't know what the right answer is exactly.
No.
You're just kind of taking educated guesses, and then you're trying it. So I really like this. I think it comes from machine learning, exploit concept, where you're trying to learn. You don't know the answer to something or what you should do, and so you're exploring maybe the external environment, and then you're learning about it, and then when you spot opportunity or you understand what to do, then that information you've acquired, you exploit it. So I think that's where you have clarity of your objective and direction, and you try exploit that opportunity. But then you always keep an amount of capacity aside to still explore. So maybe initially it's kind of 80% explorative, and you're just trying things and you have a high failure rate, and then that shifts maybe to 60 to 80% exploiting things, and you make sure people are really focused on that and are going after it sort of aggressively. And then you have another 20% at spare capacity to just sort of try things out, tolerance for failure, learn, and then that allows you to spot the next opportunity, which might be, the next segment or market you should enter, or the next product you should develop, whatever it might be. But you need to do both, right? And then over time, you kind of rebalance them. So early on, you're much more explorative because you don't know anything really. You're learning faster, and so you're trying to optimize for like fast feedback loops, quick learning, talking to like a lot of customers, getting clarity, and then driving sort of focus. I really like Andy Grove's book, Only the Paranoid Survive. So he alludes to this. He doesn't talk in the terms I do, but he talks about kind of letting chaos reign.
Yeah.
So he was the CEO of Intel, and Intel survived over many decades and has had to actually change the focus of its products, etc., to do so. And the way he did that was to actually loosen control over the business. So when he felt like the external environment was changing and he didn't quite understand why and wasn't sure the bets to make and where to focus the business, he let go of control, and he let sort of information sort of bubble up to him and experimentation to happen, and also more decentralized decisions, right?
Yeah.
To kind of find a path forward. And then once he had clarity through kind of the business finding a way forward, but also his own efforts to kind of talk to people about what was going on, when he had that clarity, then he would sort of tighten the reins again.
Yes.
So it's sort of playing with chaos, actually using chaos to your advantage, letting go of control a little bit actually was helpful.
Yeah, because it comes back to what I was saying earlier about the viability principle. You have to adapt. You can only do that with an organization that has the capacity to adapt, and you don't get that through centralized control. And there needs to be that bit where you are willing to poke and sense to the external environment to what's going on. And Intel, they've done it enough times. They've been through, numerous, technology changes that they've had to wade their way through. But it comes back to that point about that focus, isn't it? Once you have something and you know that it's, good enough bet it's going to work, you need to focus your limited resources to achieving that effect. And I think that's where a lot of companies let themselves down, because they get distracted with a lot of noise and unnecessary stuff, rather than going, right, let's focus now and let's deliver this effect at the tempo that's required, because that opportunity is not going to be open forever, as you know from that previous story about your one of your ones with ChatGPT. Those things will close, those opportunities will close, or someone else will seize it. So you need that aggression. Get there,
fast. I think that the other thing is, so investors are backing you because you're solving a problem for like a massive market, right? So you're investing in businesses that you believe can be huge. But when you're starting out, the trap you can fall into is by trying to serve too much of that market. And actually you want to do the opposite. You want to find where you have the highest degree of fit early and focus on a very narrow set of customers that generalizes to a massive market. So we've got a saying here that you want to be uncomfortably narrow.
Yes.
And you have to do that just because you don't have much resource, right? So you're like a team of 20 people with limited capital. You can't serve a huge market with a lot of different requirements. You've got to pick a subset of the market that you can serve well and make really happy. And then you're sort of stacking segments of that market over time. So you're sort of nailing a bit of it, and then you're exploring the next couple, and then you're working out which one you sort of exploit next, and you just keep doing that, and then your addressable market sort of expands over time. But a common trap is trying to serve too broad a market initially, because you've been invested in under the assumption that you're going to serve a massive market, but it becomes a bit of a trap. So you've got to navigate that as well for investors, because they also don't, like, the good ones understand you need to focus on like a small bit of the market and then it grows over time. But maybe some of the less helpful ones will feel like, oh, you're not being ambitious enough, or you're going to get stuck, which you don't want to do. Get stuck in this sort of cul-de-sac, serving very specific customer segment, when we should be going after a much bigger opportunity.
Well, that's the potential trap, isn't it? Because, like you said before, that journey through is a fast journey, and there's expected to a lot of returns on that, and that's where it can get people thinking, well, I need to exploit more. Where actually, what we're saying is that actually you need to get a foothold, and it's because of Ross Aspie's only variety can absorb variety. You can only absorb what you can absorb at that point. So you get that foothold, but then you're always asking that strategic question. If I go this way, will it still give me options?
Yeah,
and that's where you prevent yourself getting into that cul-de-sac, and then you can then exploit to the next bit. You only have to look at history. Most reasons why battles failed is because they've overexploited themselves. And then because they've overexploited themselves, they can't serve it, and they can't absorb the variety, and then they internally destroy themselves.
Yeah. I think it is really hard though for founders, because you have to make like an initial bet of where in the market you concentrate, and some of those decisions are really hard to sort of reverse or back out of. I think one of the toughest ones is, do you go kind of up market, or are you selling to enterprise? Are you serving enterprise clients, so large complex businesses, or is it sort of mid-market or SMB? And that's a really big decision to make, because it's not necessarily so easy to move up or down. It's probably easier to move down than up, because you architect the product in a certain way, and then if you try and move up, you might find that you have to do kind of a lot of rework. But I guess this is where the luck comes in, right? You sort of have to put a stake in the ground. You're making an educated guess. Might not be the right one, though, in the end. This is the nature of kind of venture capital. It is highly risky.
That's the funnest strategy, really. Strategy would be boring if it was all about safe bets and things like this. And that's why I think I do admire the founder startup arena, is because they've got to make some ballsy decisions, and they've got to make it quick. Where, when you can work in sort of the larger ones, you can sit there, I'm very frustrated about, I just want you to make decisions. We don't know it's going to be right. We just need to. And I still remember I was sat in a conference room once, and seeing the leader look to me and goes, Mike, how are we going to know this is going to work? I said, we don't. We've done all the thinking. We can make our assumptions. We're going to do something. We're going to test our assumptions, and we're going to learn from it, and then we're going to do the next thing. That's all. all we can do. Yeah.
And I think it's obviously if you're a founder or you're working for an early stage startup, that's sort of the culture. That's much more difficult in a large sort of bureaucratic organization. But yeah, I think even for founders, they can maybe be too slow on making certain decisions, and actually whether they go path A or B wasn't actually so important. What was more important is that they made a decision quickly. So there are certain decisions I think you can afford to be more thoughtful over, and there's others where you just need to get on with it, and it like almost doesn't matter, because if you go path A and you make that decision quickly and you realize it was wrong, you can just back out and go. So Jeff Bezos talks about one-way door and two-way door decisions, right? One-way door are big commitments. It's very hard to back out of them. But they're actually the minority of decisions. Most decisions are two-way door, where it's just like, if we get this wrong, we'll just change things. And I think too many people agonize, like treat two-way door decisions as if they were one-way door. And it would be better if they just made a decision, even if it was suboptimal. Like nothing's optimal, actually. You're not. So yeah, speed definitely matters, which means founders should trust their intuition, actually, because they're making decisions about things that there is no data for a lot of the time, or data is very sparse, but they have an intuition for it, and they should kind of trust their intuition. I'm also like, having sort of lived this for a few years now, especially early on, where you need to do a lot of sort of building and working out what to do, is just hiring people with good intuition and almost just like good taste in decisions. Like because you'll meet people that are just smart, and it's like on paper, you're really smart and you seem smart, but you just make terrible decisions. There's just something about the way you think, even though you've got the clock speed, that just feels off. Like you just don't get it. You don't get what we're trying to do here. And so, if I were a founder, I would definitely be just testing for kind of intuition and taste. Like, does this person have good taste?
I like that. You got to trust this person, and you want to make sure that they're going to make the sort of good decisions in those different environments. And I suppose it's exactly the same. You don't want people around that are going to make ill-informed decisions, or like you said, I like where you put it, they've got bad taste.
Yeah. It's not all about kind of what the data says, because it's sparse. You've got to make a decision. So
yeah, you think most big things that have happened, there was no data for it. It's and I think this is the thing where I always caution that data is good and fine. People often accuse me of being anti-data. I'm not anti-data, but I'm more about looking at the environment and seeing what opportunities are there. Because the best ones are going to be the things that are being explored, and you can explore those and you could shape those sooner off. You're going to create something new and create new lands that people didn't foresee. People didn't foresee that we would be obsessed by our iPhones. So there's opportunity there, which data, is not going to have the whole.
Yeah, there's no data on the future.
Yeah,
right. So, and especially in the environment I work on, it's all future oriented. So it's about inventions that the market doesn't even know exist yet. So data only takes you so far. I guess what's changed with AI is that it's much, much faster to gather. So you can be more comprehensive in the information you're capturing. So like every sales call, every internal discussion is recorded now.
Yeah.
So you're capturing, I guess, larger quantities of information with sort of high fidelity, and you can also analyze it very quickly and spot patterns, and also do sort of desk research very quickly, but like very high quality desk research now, right? You can create a really detailed, helpful report on an industry in like 10 minutes. So it's probably easier to I guess it's easier to get the data you need now.
Yeah.
Which probably leaves more space for kind of the intuition based judgments, because it's like, okay,
Yeah.
we've got all the information we could possibly have. Like, it's not going to get any better. Now let's make a decision about it.
Yeah.
Whereas before it'd be like, oh, let's go run like a customer survey, which takes 6 months. By the time you finish it, it's like the insight is irrelevant.
Yeah, the time of opportunity is too slow. And this is why I say the era now is of organizational intelligence. You can build that organizational intelligence a lot quicker, a lot higher fidelity, like you're saying, but that should, if used correctly, give you the capacity of you and your team to look out and see what that data is giving you. Because remember, we always look for, the terrain, the actors, and our own organization. And that's where strategy emerges from. Yeah, I like it. So, I've really enjoyed this in insight. And again, this is the frustration of having, limited time to have these conversations, because I think there's a whole element that we could have gone on to, which maybe would get you back to explore,
It's fun.
the latter end of the journey for them. So, Andreas, from this episode, what would you like our listeners to think more about?
There's some just fantastic businesses out there, new kind of startups, particularly in the UK. We have a really vibrant ecosystem, particularly in London. So there's just a lot of great stuff coming out. And I'd say if no one's kind of worked for a high growth, early start stage business before, and you'd like a career change, I think it's a lot of fun and a lot to learn, and probably a pretty unique experience. So maybe that's something, is like, if this is really new to everyone, to sort of investigate it a bit, and there's some great opportunities out there. Great businesses are always looking for amazing talent. So, if you want to have a go at a high growth business, I think there's plenty of opportunity out there. So maybe I'd just say, encourage people to see what's out there and give it a go.
Yeah. You definitely find it exciting. I'm always, excited about the different dynamics of that sort of environment from founders upwards, mainly around the strategies and decisions. But it's been absolutely fantastic to have you on. And for the listeners, I will share Andreas' details. So if you ever want to get in touch or find out more, or more about what Notion's doing, Notion Capital, I'll put that. Yeah, they're doing, please reach out to him. And if you enjoy this and there's other people you think you get value from it, please like and share to those. But Andreas, that's been absolutely fantastic to have you on. I really enjoyed the conversation. Thank you for joining me.
Yeah, me too. Thanks for having me.
No, a pleasure.
Cheers. Take care. Bye.